A diplomatic pause between the United States and Iran is moving three markets at once, and the direction is telling. Oil prices fell in recent trading after both countries signaled a break in their standoff. Treasury yields dropped too, and U.S. stocks closed without a clear winner among the major indexes. That split outcome tells you something important. Markets are relieved, but not convinced. Here is what is happening underneath those moves. When tensions rise in a major oil-producing region, traders build what is called a risk premium into crude prices. That is the extra cost the market charges to account for the possibility of supply disruptions. The disruptions do not have to happen. The fear of them is enough to push prices higher. When the fear fades, that premium gets sold off quickly. That's what you saw today. The threat eased, and traders unwound their positions fast. Treasury yields fell alongside oil. Yields move in the opposite direction of bond prices. When investors buy U.S. government bonds as a safe haven trade, prices go up and yields come down. When that defensive rush starts to reverse, when people feel slightly safer, bond prices ease and yields typically rise. The fact that yields fell anyway suggests some investors are still not fully comfortable stepping away from safety. The picture is not entirely clean. Stocks reflected that same hesitation. A mixed close across the major indexes, with no clear direction, is often a sign that markets are pausing to assess rather than committing to a new move. A diplomatic pause is not a resolution. Investors know from experience that geopolitical situations can escalate again quickly, and they tend to stay cautious until there is more clarity. The broader economic implication worth watching is inflation. Energy costs run through the entire economy. They affect the price of goods, transportation, and services. When oil falls and stays down, those lower costs can gradually work their way into consumer prices. That would offer a small measure of relief for the Federal Reserve, which has been working to bring inflation lower. It is not a game changer on its own, but a sustained drop in crude would be a modest positive for the Fed's outlook. The key word is sustained. One session of lower oil prices does not reset the inflation picture. Markets will be watching whether this diplomatic pause holds, or whether renewed tension pushes crude and safe haven demand back up. The practical takeaway: when geopolitics drives a market move, track whether the underlying condition has actually changed, or whether the market is just pricing in a pause. A pause and a resolution are very different things, and right now, this looks like a pause. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.